there is so much involved in just deciding to invest passively. It's so painful. The more you read of that, the more you realize, man, why would I want to do this? They don't design their own lawnmower engines or create their own egg beaters. Why would they try to get involved in picking their own stocks? The parallel in real estate is, do you really as a passive investor know enough to pick the best deal? Maybe not. So really lean heavily on finding the right operator who put a lot of their own skin in the game and has a lot to lose if it goes south.
Welcome to Truly Passive Income. I'm Clint Harris.
And I'm Neil Henderson. Paul Moore is a good friend and the founder of Wellings Capital, a real estate private equity firm managing roughly $180 million in investor equity across self-storage, mobile home parks, industrial, and other commercial assets. Paul built his investing philosophy the hard way, losing money as a self-described certified shiny object chaser, before adopting what he calls the boring investor approach, applying Warren Buffett's core principles directly to private real estate. Paul, always great to see you.
Great to see you. Good to be here. Thanks, guys.
You know, I'm not going to go over your bio here. I'm not going to say, hey, Paul, how'd you get into real estate? Like, let's skip all that fluffy stuff. We know you. You're out there. If people want to learn more about you, they're going to figure it out as we talk through this. You draw a really sharp line between investing and speculating. And you've said you spent years on the wrong side of that line without realizing it. For someone listening who has capital to deploy but isn't sure which side they're on, how would you walk them through that distinction in plain terms?
You know, you would think somebody with an engineering degree and an MBA would have known better. But after 5 years at Ford, 5 years as an entrepreneur, I thought I was a full-time investor, but I was more of a full-time speculator. I sadly didn't know the difference. Part of the core problem here, in addition to being a shiny object chaser and a certified FOMO guy, I thought I should get the same excitement out of investing that I did out of being an entrepreneur. I was only 33, had a couple $1 million, and I made the mistake of trying to think, oh, this investment seems exciting. It seems fun. Fast forward 25 years, like last year, my company looked at 1,137 operators and deals, and we only invested in 6. If it would have been 25 years ago, I'd have probably invested in like 6 of the first 7, And, speculating, investing is when your principal's generally protected or protectable, at least, protected in specifically by having current income, for one thing. And speculating is when the price is completely not, and your investment's not protected by income, and it's whatever anybody thinks it's worth, and hoping that the next person will pay more than you. I think kind of the core issue goes back to is what is true wealth? Is it a mansion or cars or boats and all that? I think we all know that's not true, but true wealth is having assets that reliably produce cash flow. And to me, that's what I'm looking for at this point in my investing career.
It seems to me like a lot of people have realized or found out the hard way over the last 2 to 3 years that some of their investments were speculative.
Yeah.
And a lot of people didn't feel that way or know, especially anything multifamily prior to 2021, 2022. It felt like you couldn't miss. Like
Right.
Everybody was making money hand over fist. It was everyone was killing the game, and all of a sudden, you found situations where when the interest rate shot up 2,100% higher and faster than it ever has in history, and a lot of people scrambling with variable rate debt and couldn't get that repositioned, that it created exposure. And then you have the market slow down, and some people had a business model that works great as long as rents continue to go up. And if you ever get to a position and we've even seen that in Austin, Texas, where that's not happening, all of a sudden the wheels start to come apart. And over the last few years, you've had a lot of people that if there were flaws in their strategy, it's been exposed. And there's been some real challenges navigating the last few years. So frankly, I'm really surprised to hear that you guys underwrote 1,100 offerings last year. That seems like a tremendous amount of people still trying to operate right now.
Yeah.
But what do you has your mentality changed over the last few years, or for the investor, it felt like everybody was hitting home runs and then all of
Yeah.
a sudden no one was hitting singles. Um, but at the same time, it's a scary time to look at alternative investments. But to me, it feels like the people that are still doing it, still operating, have been stress tested. They are battle hardened at this point, and you've been able to see the results of the decisions that they make. So it kind of feels like a downturn like this creates opportunity to see
Yeah.
whose business strategy could actually handle the stress. So how does you approach that with what we're seeing right now?
Yeah, I mean, after doing a very few number of commercial deals after, a long time in residential real estate, I wrote a book that was humbly titled The Perfect Investment about multifamily. It came out about 10 years ago. And then I went on Bigger Pockets where I had a little show on their Instagram and Facebook live channel. And I went on a lot of blogs and podcasts and said, time out. I was wrong. It's not the perfect investment if you have to overpay for leverage, use risky floating rate debt, and believe that trees, aka rents, will actually grow to the sky this time. I said this is going to end badly, and I think it was fall of 2017. I was really sounding the alarm. I said we just hit the what looks like a top. I think it's going to, about to go off the cliff, and then of course we all know that in December 2017, Congress and the president passed the the tax change with accelerated depreciation, uh, you know, making it much more accelerated, I should say. And the cycle took off again, and we all know where it changed, where it reversed in 2022. But you know, in that time frame, it's been way too often quoted, but that rising tide did truly lift all boats, and it was impossible to tell who was really a good operator and who was a good promoter. In fact, the problem was exacerbated by the fact that the more risks, the more the amateurs took bigger risks and they actually made even better returns because the market rewarded the people with the highest leverage. And the same deal, the same exact deal in every way, leveraged at 50% versus 75%. Well, the 75% leverage, I'm not saying that was wrong, but it got twice the returns, at the time of sale, at least from appreciation. And that's what was the big thing. And so, of course, we all know now that, as Buffett said, the tide's gone out and we found out who was skinny dipping. And so it is easier to tell now. A lot of folks that I know in my masterminds over the years have moved on to other things. They're not doing multifamily investing anymore. And one thing that changed in answer to your question, finally, was we started valuing the capital stack position as perhaps as important as anything else. Of course, the operator we think is king. I mean, the jockey is more, in our opinion, once you have a good horse, that would be an asset type in my mind. The jockey is incredibly important. The right operator can turn around a mediocre deal. A bad operator can destroy the best deal on the planet in so many ways. But the capital stack position is something we hadn't even thought of for years. And finding a safer position in the capital stack with similar or the same upside as the people in the riskiest position in the capital stack is something we have really appreciated at Wellings Capital over these last 3 years. And we've been really, really focused on that more than ever now. Yeah, I mean, basically, it looks like JV, we call it JV hybrid equity or preferred equity positions, which again, have maybe the same upside in many cases as the LPs, but they are not affected by, let's say, a 10 or 20% loss in principal because they're in the middle of the capital stack.
Yeah, that was my next question is if you're negotiating those positions like most preferred nation or you getting paid out first, you have, especially right now, if you are placing capital, There's not a lot of people doing that over the last few years. There's still a little bit of capital being raised on the LP level for the right deals, but certainly not the way it was in years past. I've heard numbers of people saying they're raising 70% less capital that they were over previous years. So if you're placing capital, there's a premium on that. People are spending more money on advertising, and the cost of capital is going across just for the acquisition cost. But then traditionally, you're having to offer higher returns to the investors. And it's a little bit of a buyer's market if you're placing capital, which puts you in a position of, hey, we'll take this percentage of the raise or the whole raise, but this is what we want. We want most preferred nation. We want pref equity, whatever it may be. Are you finding yourself negotiating those positions, or are people just having to start offering that?
We put the word out among a whole bunch of debt and equity brokers and commercial real estate brokers in general and operators that we are offering that. And so, what's facilitated this in part is the fact that lenders who might have done a 75% loan before, or maybe at 55, and now those same people who were raising 25% equity now need to raise 45 to fill the gap. They're raising less. Like you said, they might only be raising 15. And so there's that 20 or 25% gap in the middle of the stack that we're willing to fill. We'll be the largest check writer, but for that, we get forced sale rights, management takeover rights if needed, budget approvals, the right to, to decide whether we're going to allow them to draw money for value add, et cetera. And those things aren't going to hurt a great operator at all, because if they're doing everything they're supposed to, none of that matters. If things go south, though, there's so many ways that could happen. The more we learn, the more we realize, the more we realize how we and others could be hurt. And we've been hurt. I'm not going to lie. Um, we found that due diligence on the operator, the deal, the debt, everything else is more important than ever as we see, this last 3.5 years of market shift.
So within that due diligence, you said last year, or this past year, you guys have underwritten over 1,100 deals, and you've invested into 6 of them. That's less than a 0.5% conversion rate on all those deals coming across your desk. So what is it that makes 1 out of 200 potentially stand out to you guys? Like, what are you looking for that's the needle in the haystack?
There are so many things. We have a 31-point due diligence checklist, and, people can email me if they want to get a copy of that. But we're looking for the right operator. And sometimes that could be gut feel. Sometimes we could be in their office and we could see how they treat their employees, how they talk about their spouse, how they talk about their investors, how they treat a waiter at a restaurant. We do a deep criminal check, reference check, background check. We spend thousands of dollars on these type of things. We do death by Google. We check the loan documents. We really read all those loan documents. We try to figure out, what could go wrong, if there's any fraud in their background of the partners. And, that's the number one risk, is fraud. Everything else can go perfect, and one fraudulent CFO can ruin everything. We all know this, but it really is a risk. And I think in the last few years, in addition to the other problems that have been out there, some people have been the victims of fraud. Fraud sometimes isn't even ever found out. You hear about the ATM thing. We all know about that, things like that. But there's other times that, what if the return you should have got was 19%, but you only got 16, and you never knew that they were skimming 3%? That's fraud too. And so, we want to put in every imaginable control. We want to stay involved. We've added an asset management team because we realize passive investing isn't really passive in many cases, especially on the due diligence side. The more we do up front, hopefully, the less we'll have to do over time.
Yeah, you touched on something that we talk about on truly passive income all the time. It's kind of a joke. Really, truly, the only thing that's truly passive is maybe your savings account. And maybe your 401k, but there's still decisions that need to be made. Taxes, there's tax forms you're going to have to download maybe every year and handle that way. Even with these, quote unquote passive investments in real estate syndications, there's an enormous amount of due diligence that happens up front
Yeah.
if you're smart. Now, I talk, I'm amazed at the number of investors I talk to that 2 phone calls, offer memorandum, maybe read the docs. I there's a lot of times I wonder, and then, what are the wiring instructions? And I see that a lot. You know, if it's your money, you can do with it what you want, but it's always like, I want to know a little bit more about these people and what this deal is, and really get in there and understand some of the particulars of the operating agreement, the uh, the business plan.
Yeah. Charlie Munger said, if you think it's easy, you're stupid. That's part of the reason they have to find somebody they can really know, like, and trust. Because let's face it, the average passive investor is not going to be able to figure out if there's an error in cell E37 that messed up the whole spreadsheet. They're going to have to trust that operator. They're going to have to trust their track record. A hundred other things. And, the due diligence on here's the thing. You guys know the book by Brian Burke. I think we all know
Hands-off
it's
investor.
Hands Off Investor. Anybody who reads that 350-page slog should know there is so much involved in just deciding to be a hands-off and to invest passively. It's so painful. The more you read of that, the more you realize, man, like another Munger quote is, why would I want to do this? I mean, people don't they don't design their own lawnmower engines or create their own egg beaters. Why would they try to get involved in picking their own stocks? Now, that's the Munger quote. The parallel in real estate is, do you really, as a passive investor, know enough to pick the best deal? Maybe not. So really, really lean heavily on finding the right operator who put a lot of their own skin in the game and has a lot to lose if it goes south.
And that's the idea behind Wellings Capital, right? Is like, it's a classic who, not how. I don't
Yeah.
need to know how to underwrite deals, how to find the right operators, how to put blinders on and not be, caught up with the shiny object syndrome. I need to know, who do I know that's better at that than I am? That's got a track record of maybe even doing it wrong first, but doing it right for a sustained period of time during some significant ups and downs in the market. That's what you're getting by bringing in a hired gun to help make those decisions for me. I'm curious to know the answer to this, but I have a feeling it probably is. But if someone shows up with you and partnering with Wellings Capital to help them place capital, I'm assuming the first conversation is, okay, well, what's the goal of this money? It's not like, well, here's the menu that we have. Are you taking an approach of like connecting with an investor, finding out how much capital they're trying to place? What are they trying to accomplish? Or are you steering people to individual asset classes that you suggest? Are they making suggestions? How does that process work when someone engages with you?
Yeah, that's a great question. For years we have 8 funds right now, and our third through sixth. So those 4 or 5 funds over, like 5 years, we tried to hit income and growth in the same fund. And, we've had a lot of success with that, but I think we could have been so much better because we turned down the best growth deals because they had no income, and the best income deals because they had no growth. And now we've separated into an evergreen, and we lost potential investors who wanted to, follow Buffett and say my ideal hold time is forever because we were only 10 years. More likely, we lost people because they only wanted to commit for 5 years and we were 10 years. So now we have an evergreen income fund that is mainly focused on incomes. We're trying to get 6 to 9% plus 3 or 4% growth when they exit. And they can stay in there perpetually, hopefully continue to get depreciation. Some people really focused on depreciation losses this time of year, and that's great. Then we have a growth fund, and we say, look, if you don't need the income and you want to just be in for 10 years flat, you could be in the growth fund, but we do these certain asset types. I mean, we're focused on self-storage, mobile home parks, light industrial, commercial retail, and multifamily. And again, and we're also focused on that middle position in the capital stack, which we think is a better risk adjusted return. Those 6 deals we did last year will not turn out to be the best returns, but they'll be hopefully be some of the better risk adjusted returns if all goes well.
So describe for me sort of what that structure looks like. I assume you're talking about preferred equity, correct? Instead of
There's 2 different types of preferred equity, and I could describe the 2 if you wish, Neil.
go for it.
Yeah, so classic preferred equity, a lot of people think of that as, oh, that must be rescue capital. We don't do that at all. Let's take that off the table. We believe in preferred equity for ground up development, but we don't do that either. We're just a little too gun shy and conservative. Preferred equity might look like, a new operator's got a value add deal. They've got 55% debt. They've raised 15% of the 15 of the 45 of equity they need. And we bring in 30% of the equity, from the 55, starting at 55% loan to cost up to 85. Hope I did that math right in my head. And by bringing that in, we, as a preferred equity provider, we would get something like 7, 8, 9% current pay. In that way, it's similar to debt, but we don't have a lien. And we also have accruing compounding upside, and that might be another 5 or 6 or 7%. And that, in that way, it's like equity, but it doesn't have unlimited upside. If it goes really, really well, we don't share in that extra upside, if you will. We're limited to, let's say, 15% total annual return. That's preferred equity. One thing we like about it is if, and heaven forbid that deal drops in value by 12%, well, that 12 comes out of that's 12/15 of the LP's equity. It's crushing to them. But if that deal goes up 30% annually, we only are at 15. That gives extra return to those LPs who are taking all the first risk. That's preferred equity. The JV hybrid equity is a term we made up. It's a hybrid between that preferred equity I just described and LP equity. Here's how. We're still in the middle of the capital stack. We still bring in that same 30%, but there's not a fixed return. We're pari passu. We're on the same footing, same basis as the LP equity. And therefore, while we're in the middle of the capital stack, whatever returns, if they're getting 6% cash flow, we get 6. If they get 12, we get 12. And if the deal is refinanced or sold, our principal's paid back first, especially at the time of sale, that matters, before the other investors. And that means, again, if the deal loses up to 15% in return or in value, our principal's not touched. And in that way, it's preferred. And if the deal breaks even at the time of sale or better, again, there's no impact to the operator and to the LPs from the fact that we're ahead of them in the capital stack. Does that make sense?
It does, and what you're doing is protecting your downside.
Yes.
It's another hedge against, it's 15% drop in value.
Right.
You don't lose a dime. I mean, sucks for the other guy, but
Right.
and that creates a margin of safety, which, we love margins of safety.
Right.
And then, with that margin of safety, all right, well, maybe we got less upside, but in this day and age, I'll take that margin of safety over sky high upside.
Yeah.
Because the upside's still pretty good.
Right. Yeah, absolutely. That's a Buffett. Everybody who's studied Buffett for 5 minutes knows, not only the margin of safety, but just the fact that, if you can just continue hitting singles and compounding those singles over 60 years, people doubt that this could possibly be true, but you can do the math yourself. Warren Buffett, if you took Berkshire Hathaway's gains over 61 years and compared it to the S&P 500, Berkshire Hathaway could lose 99% of its value, meaning 99 cents out of every dollar slashed, and it would still wallop the S&P 500 in the last 61 years. That's pretty impressive. And the focus, again, was not losing money. Buffett, and especially Munger in this case, who is considered the smartest investor on the planet by a lot of people, God rest his soul, Munger's focus, as smart as he was not on doing smart things. It was avoiding dumb things. Thinking through that is pretty powerful.
It's amazing. In terms of everything you're looking at right now, is there an asset class that gives you the yips in general, or does it always just come down to the operator, the deal, and the structure?
Is there an asset class that what again?
That you're a little bit, that makes you a little bit gun shy right now. It gives you the yips. Just you're looking at
Yeah,
Golf
yeah.
terminology.
There's a lot of people looking at multifamily, and I think it's just recency bias, but
Yeah.
it's a once bitten, twice shy.
Yeah,
We all know that you can do real estate deals in any environment.
right.
My parents bought their first house. I think it was 16% interest.
Yeah,
You can do deals in every market because the fundamentals are always the same. But the reality is, certain seasons and different asset classes do better at different times, depending on where we are in
Yeah.
the cycle.
No, I got it.
And a lot of recency bias. So are you seeing through that and still looking for diamonds in the rough, or are your investors, is the tail wagging the dog and the investors are wanting to lean away from that asset class?
Yeah, we just as an example, before I answer your question, we did a manufactured housing deal exactly a year ago. We launched it a year ago this week, and I think we had raised 7 million in 5 days, and we had a waiting list of 32 investors who didn't get in within a few more days. 4 months later, we tried to do a student housing deal, and we slogged and grinded for 45 days to raise half that amount of money, about 3 million. And then we walked away from the deal, had nothing to do at all with that. We had the money in the bank. We had 115 investors. We had to call and say, hey, we found something in the last moments of due diligence that made us walk away. Sorry, we're wiring your money back to you. So, I mean, that's an example of, our investor bias. It's certainly toward mobile home parks and self-storage. I will answer the question now, and that is, we are more focused on the operator, the deal, the structure, the capital stack position, the fundamentals. I mean, we've invested with an operator recently who's been doing the same thing since 1973 and had an incredible track record, but it's in multifamily, which is not as popular as manufactured housing, mobile home parks, for example. But we were able to raise the money and move forward with them. And we've done more multifamily than anything, though we ran hard away from it from 2018 to 2023.
What are you and I met at a self-storage conference.
We
I think
sure
it was,
did.
yeah, it was Vegas. I think it was probably 2018. It was
2018. That's
probably
right.
you running away from multifamily. I caught you.
That's exactly what it was.
And, I was a baby storage investor trying to get into storage then. And
Me too.
And storage, storage has been battered the last 5 years as well. Certainly nothing like multifamily. But I'm curious from your side, you're not coming from the operator side, but I'm curious from the investor side what you have been seeing in storage.
Well, I mean, we all know that self-storage got overbuilt for a while, but that's very market dependent. Guys, one of our best deals is, get this, I mean, just to put it in context for the listeners, a lot of the and you guys can disagree with me, but a lot of the big, beautiful self-storage facilities you see along the 4-lane highway in DC or Charlotte or Wilmington, a lot of those are around 100,000 square feet. Just to make some context here, we have 165,000 square foot self-storage facility in Ishpeming, Michigan, if you can imagine that, and it is crushing it. And they're not worried about Public Storage or Easy Store or Life Storage or anybody else moving in down the street. And so it's very market dependent. It depends on how you buy it, who you buy it from, mom and pop operators who I'm thinking of one in Vegas. Speaking of Vegas, we're the largest investor in that one in Ishpeming, Michigan. We're also the largest investor in one in Henderson, Nevada, which I think maybe Neil used to live there. I don't know. Maybe they named it
Summerlin.
after you. But
One of my ancestors.
okay, there you go. So they were leasing at $60 for a 10 by 10. This is recently. And it was not filled, but it had a whole bunch of homeless people living there, which is illegal and unsafe, by the way. It was a mess. The same person who built it in 1980, maybe 82, still owned it. And, the going rate for those 10 by 10s once the place was cleaned up was 148. I mean, it's hard to mess that one up. It's doable if you got a bad operator, but I think that it depends on those items. And, the best time to invest when's the best time to invest in office? Probably right now, because it is so unpopular.
Yeah.
Yeah.
It's terrifying. Do you want to be the first one in? I mean, we looked at office hard, right? Do you catch the falling knife? Is it at the bottom? And it's hard to say. So
Right.
it's a scary time to jump into a new asset class.
Right.
If you haven't already been in there, you certainly see opportunity, but it's scary. I
Yeah.
think we'll leave that for the people that have been doing office for 20 years
Yeah.
and can figure that out. I know that we got to start wrapping things up here. We got a hard stop momentarily. But I really want to focus a little bit more on Wellings Capital before we do that. So tell me about what it looks like if someone engages with you. What are the minimums? How long you guys? I know you've been around for a long time. You probably have close to 200 million that you guys are managing at this point. But what's your average investment size from an investor? What's your minimum, and how long has the average investor been with you? Explain to me kind of what the relationship looks like if someone engages with Wellings Capital.
Yeah. Neil, when you and I met at that conference, I think we had a handful of investors and, probably at 50,000. 50,000 still our minimum. All of our investors are accredited. Most of them are considered retail investors. They're not, institutions or RIAs or family offices, though we have a few RIAs and a few family offices. We have 1,100 investors. The average first-time investment, oddly, year to year is very similar, and that's around $85,000. That's just the average. In 2024 and 2025, both years, our reinvestment rate was 73%. So 73% of our investments, in other words, that we got in the door in those 2 years, were from people who had invested before, and that puts our average number at about $205,000. That's our average investment. We have investors, a whole bunch at 50,000 and then a few above 2 million. And so as far as the average time investors have been with us, I do not know the answer to that one.
And then when you have an opportunity for, let's say you guys are looking, you find a deal that you like, you find those 6 out of 1,100, then you're launching that out to your community and everybody just opts in or opts out to learn more about it. And then ultimately they make the decision, or you actively placing capital for people that are like, look, just put it where it accomplishes the goals that I've told you I need to accomplish.
It's actually both. Great question. So we have an evergreen income fund. And in that fund, we're investing in all those same asset types we talked about. And people are saying, look, we trust you to diversify our money across multiple asset types, geographies, operators, capital stack positions, and projects. Then we also have a 10-year growth fund. And again, it's 50,000 minimum, accredited. And again, they're trusting us to put it in manufactured housing, self-storage, multifamily, etc. In addition to that, sometimes we get deals that they fit in one of the funds, but the size doesn't. So let's say in our growth fund, which is currently only $10 million, it's a pretty new fund. If we got an $8 million opportunity in there, we might say, I don't think we want 8 million, in one deal in this fund. So we might go out to the market and say, hey, we'd like to do a $5 million sidecar and then 3 million in the fund. And that's where the 8 would come from to get into that deal. So we do have sidecars, and people can know what they're getting into. They don't have to trust us as much for the future, and they can actually have a better idea, though no certainty, on what their depreciation loss will be because it's in one asset.
Well, goodness, Paul, we could go on for probably another 2-3 hours easy.
That'd be
You've got a
fun.
hard stop. I've got a hard stop. We got to find some more time to get together and chat. I always enjoy it.
I would love that.
So a question we ask every guest, and I'm curious to hear what yours is going to be, is there a book or a resource that you find yourself recommending to friends and family and colleagues more than any other?
Yeah. As a previous certified shiny object chaser who was obsessed with FOMO and now has graduated to FOMU, that's fear of messing up. I still recommend the book I read 12 years ago, which is The One Thing by Jay Papasan and Gary Keller. And that book has really, really helped me just focus and say no to 10,000 distractions to focus on the one thing that I need to focus on, that was just revolutionary for me.
Love it.
Yeah, same.
I actually don't. I know the book. I'm not sure we've actually ever had it recommended.
All right.
It's been brought up before in conversation, but I don't think that's ever actually been anybody's recommendation. Abby and I actually read that together not long ago. Yeah, it's very impactful, especially much like you. I have shiny object syndrome, ADD. I'm all over the place. I see opportunity everywhere, and sometimes that results in opportunity nowhere.
Right.
Unless you can really dial that in. So
that's true.
Listen, Paul Moore of Wellings Capital, really appreciate you being here. Always a pleasure to connect with you. I gain something from our conversation every time. If any of our listeners are struggling to find their own deals and would rather have a professional help them, or are interested in learning about you or learning more about Wellings Capital, what would be the best way for them to connect and do that?
They could come to our website, Wellings Capital. That's WELLINGS, wellingscapital.com. And they can get some free resources there, including access to my book. It was published by Bigger Pockets on self-storage, or a special report on self-storage, mobile home park investing, and much more at wellingscapital.com/resources. You can also ask for our 31-point due diligence checklist.
Excellent. Thank you so much, Paul. We appreciate your time.
Clint, it was great to see you. Neil, same to you, and hope we can do this again.
Take care, Paul.
Thanks.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.